Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets closely associated with them. And Miles, without further ado, let's jump into your little Cliff Notes version of what's transpired over the week with the precious metals.
Yeah, we've had some volatility over the past week, but let's just take a look week to week from our recording last end of Wednesday, Thursday, when we put our show out. So gold up about 3%, playing around with 2450 at the moment, at time of recording right now. Most of that, though, has happened in the last couple hours. So we'll dig a little bit more into gold as we look at the charts a little bit more in depth here in a minute. So moving over to silver up a little bit more, 3.8% from last week to now, pushing just above $29 again. Still under 30, but we're moving back up that way, and there are some levels we'll take a look at there on the silver chart in a second. Platinum following suit of the metals, doing the best this week, up 4.3% to $977. Unfortunately, still below 1,000, but we're getting close again. And palladium up as well, about 2%, still sitting a little below platinum at $913. So all the metals holding pretty nicely this week, with platinum and silver taking the big move up. This is kind of across the board with the equities as well, although not as much. The Dow up 2.5%, S&P up about 1.7%, and the Dow Transports with not a bad week, up 3.8%. Although still, when you look at the longer charts, the Dow Transport's still lagging behind the other indicators. And finally, that comes on the heels of the dollar still sitting in that big trading range we've been talking about for the last number of months. So relatively stationary, the dollar down around 0.25%, sitting just above 104. So all of that doesn't sound like week-to-week big numbers, but we've had some volatility across the board.
We have, and remember 2 weeks ago when we recorded, guess where it was? Right where it is right now. So 1 week down, the next week back up. Gold doing this chopping sideways, kind of as Eric predicted through the summer. Mm-hmm. It does appear more and more as if we put the low in.
Yeah,
Rob,
it sure looks like it to
for
me.
the summer anyway.
Yeah.
Yeah, but the chopping's been going up, and I think that's the big thing here is this is cooling off. You know, one thing I've talked about in the past is a market can cool itself off one of two ways. It can either reverse, take a nice big crash back down and blow off some of the tops, or it can just sort of sit sideways for 3 or 4 months. So I think gold's looking real strong. We may not see that sub 2,000 gold price maybe again for a while.
If ever.
Yeah, I think if ever might be the correct answer.
Well, I mean, today at the close of July, this is the highest monthly close ever for gold at just around 24.50. The previous highest monthly close was over $100 less. So we are definitely stair-stepping higher.
Yeah, it's a good point. In fact, since its February low, when it started its upturn, gold has not produced a down monthly close. Like this many consecutive months of higher closes is the ultimate stair-step pattern.
Yeah.
So very, very bullish and aided certainly geopolitically. I mean, we may as well dig deeper into the gold chart here, Miles, but geopolitics is not a long-term sustainable wind in the sail of the gold price, but it certainly can have short-term effects. And you did have the assassination of the chief political leader of Hamas last night in Tehran, actually.
Mm-hmm. Yep.
And so that certainly has created more turmoil geopolitically in the Middle East, certainly without any cooling in the other hotbed areas globally. So certainly a concern, as is our own domestic political instability that is obviously leading to instability globally and bold and brazen acts.
And markets hate uncertainty. They hate volatility. They just do. So we'll see how this all pans out, but I think we've seen the low for the price of gold. Let's hope that silver can catch up, because what's the ratio, right around 85-1 right now?
Yeah, it came down about a point from last week. So we did have 85.5. We're now 84.5-1. And again, still screaming by silver. But what silver needs, as we've talked about on the show, is a little bit hotter economy.
Yep.
And we'll get into the FOMC, the Federal Reserve, here in a little bit too, as far as underlying fundamentals go. But Miles, certainly nothing's changed technically for you, right? I mean, in terms of support and resistance levels?
No, in short term, I think short term support and resistance on gold adds a lot of weight. Rob, to your thoughts that as we're pushing out of the summer, we may be seeing the end of the sideways pattern sooner than later here. So if you look at gold, since we bottomed back at the end of June, down around last time we hit kind of that bottom of the trading channel, down around 2,300 ish at the end of June, and then obviously all the way up to new all-time highs 2480, 2485. We failed to come all the way back down to the bottom of the channel. You know, we've been in this long channel since April. Like I mentioned, we had a big run up this spring, and then instead of having a sell off, we had some sideways trading for the last couple of months. So we built this nice rising channel. We came back up to the top. So bottom on June 26th, top on July 17th. And then we had sort of a Fibonacci retracement back to the 786. It was deep, but we didn't come anywhere near the bottom. Well, now we're flirting with that old high again. If we start to see gold pushing into the 2450 to 2480 range, I don't see us putting in a double top here. I really don't. I don't think it has the bearish strength behind it. I don't think there's enough sellers in the market right now. I think most people are gold buyers because of the other things we're talking about. We've got political instability in the US, the Middle East, Eastern Europe, and still we've got the China-Taiwan issue on the books as well. So I think there's a lot of people coming into this fall that are seeing some uncertainty out there and thinking to themselves, what are we going to do? What is lowering interest rates in September going to accomplish for us? Equity market seems to be fine.
Well, the markets didn't seem to care.
Yeah.
They didn't get the rate cut they had hoped for, or the announcement anyway. Stocks were still up, gold was still up, dollar still down, bonds still up, interest rates went down. It's like the market said, well, we don't really need the Fed to lower interest rates, we'll do it ourselves.
Well, it's always been manipulation from the microphone. Shiloh and I were talking at lunch about the fact that that's all they have to do. They don't have to have a rate policy change. All they need to do is say that there is one looming on the horizon, right? And that's September. So there was about a 7% chance of a rate cut today. Of course, it didn't happen, but supposedly it's about an 85% chance in September, which will be politically convenient. But at the same time, what's it going to be? A quarter of a point. And Powell is saying, well, the job market is cooling, but if it starts to pick up too fast, then it would be a justification. Like
he's happy
cooling
that there's
effect.
less people employed.
Yeah, it's terrible.
And he's happy that the wages are down.
As long as it's a slow boiling frog in a pot of hot water, it's okay. But if the water gets turned up boiling too fast, then they'll cut rates.
Yeah, if Americans get jobs again and their wages start going up, that's bad.
That's right. It'll drive inflation, much less make living affordable again. Because the wage growth, that's a big thing. It's one thing for prices to be too high. It's another thing for wages to be going down or people losing jobs. And when they set out on this journey, they said they needed to see a 2 million job decline in the U.S. labor market. Well, they're seeing it, right? So, of course, the economic numbers aren't going to be rosy rolling in. And next month, the CPI is going to come in hotter. June was better. You're going to see July and August will be higher, just the way that those averages work out. So that's a primary underlying fundamental. But the debt and the money supply, again, as long as we're on gold here, this is what gold does best. And the money supply is not changing.
Nope.
The debt is not changing.
Nope.
And so the debt issue, I mean, the Treasury just said in a statement Monday that it estimates $740 billion in borrowing for July through September. So this is the fourth quarter of this fiscal year. And so that's on pace for $3 trillion added to the national debt per year. And Rob, you have beaten that drum over and over again. Therein lies the biggest problem to me.
Yeah, they're just not going to get their handle on spending. They're going to continue to borrow money.
So what you're telling me is the thing that's the biggest problem is the actual definition of inflation.
Correct.
And that's where you stick a quarter in me. You guys heard me complain about this before we started recording today. Rob, you put it succinctly. What is the definition of inflation?
It's the increase in your base money supply.
See, that's interesting because when I go to Investopedia here, I read inflation is the rate at which the overall level of prices for various goods and services in an economy rises over a period of time. Well, that sounds like a symptom. not a disease.
An effect,
Exactly.
not the cause.
Yeah, that's what we're getting at. And Tori, while we were talking earlier, you brought up a point, and I think this is important. How the heck does more unemployment decrease inflation?
And decreasing wages decrease inflation.
Well, because people aren't able to buy. Of course, prices have to come down because supply goes up because demand drops. I get it. It's sort of a math 101 in a sense.
True.
But on the back of the taxpayer, on the back of the average citizen that's just trying to get by. First, they had inflation end up as a result of bad fiscal policy. So they get sucked into an inflationary cycle. Now it's even harder to make a good living. And so things are less affordable and you have less money coming in, or you're working more jobs. All for what? Just so that they can cool the economy and correct the mistake that they made. Remember, people protest the wrong thing. It is the government's fault for sure. We're hearing this, right, from a fiscal policy standpoint. But the Federal Reserve is the creator and destroyer of bubbles. And it's almost like a game that they're playing where they let it build and they let it blow.
Well, I'm going to do it 2 weeks in a row. I can't believe it. But Jim Rickards, again, I mentioned that video or the interview I listened to Rickards last week. Well, what do you call it when you have in an economy at the same time the following things? Appearance in an economy of slow growth, high unemployment, and raising prices at the same time. Because they're talking about slowing growth and raising unemployment, hoping that it will decrease prices. But what happens if it doesn't? And you get all three of those things at the exact same time. There's a word for that too, and that's stagflation.
That's right. We've been calling for stagflation for 2 years.
And it's scary.
Almost. Yeah.
That's a lot scarier. Because now you got people that are unemployed and they couldn't afford to buy anything even if they were.
Well, and what it leads to is an inflationary depression.
Yeah.
Yep.
And that's
Yeah.
the ultimate downfall because the Great Depression was a deflationary depression. The dollar was very, very strong. You just couldn't get it. An inflationary depression is totally different. The dollar doesn't have any spending power. There's plenty of money, too much money. It just doesn't go anywhere. And Don McElvaney has been calling for the ultimate inflationary depression for decades, saying with monetary policy, with Ben Bernanke being helicopter Ben, because he said you can avoid a Great Depression or a deflationary depression by just flooding the market by dropping money from helicopters into the citizenry. Well, that's what happened post-COVID.
Right.
That's what this was an attack against deflation with COVID shutdowns. It was an overshoot, and here we are, and yet I don't think we've seen anything yet.
Not yet. And you mentioned that the last Great Depression was a deflationary depression, and then you have had pundits talking about gold going down because of deflation, but during the last Great Depression from the 1930s, gold actually increased 75%. So gold does well whether it's inflation or deflation or echospasm, like the term that Don McElvaney talked about 40 years ago, where you have inflation and deflation occurring simultaneously, and it's like sitting at a traffic light with the signal blinking red and yellow and green, but out of order and all at once, and it sends mixed signals to people, and they don't know what to do.
Well, what you do is you own gold,
Yeah.
is what I hear you saying. And it does. It does well in deflation and inflation,
Doesn't
unlike
matter.
silver, right?
Yeah.
Silver has been lagging. Let's
Right.
transition over to that because we don't want to leave the silver charts out. Miles would feel forgotten. So, Miles, let's jump in.
I've done my fair share of politicizing today, so I'll apologize for that one. I tried to stay the chart guy, let you smarter people talk politics, but you got a quarter in me today, so.
No, but let's jump into silver because it's
Sure.
closely related, right? I mean, the economic tie-in is huge. It's an industrial metal. The white metals in general, platinum and palladium, we can kind of talk about all three of them and why they're apparently lagging. As Rob asked, the ratio, it's 84. That means silver is greatly undervalued. Well, platinum is less than half the price of gold, and we've seen it twice the price of gold. So,
But the big
course-
question here, Tori, is are we going to have an industrial expansion on top of a monetary expansion, a monetary base expansion? And we don't know that yet. I don't know who gets in the White House this fall. I have my opinion, but for the white metals to do their thing, we have to have a strong economy. There has to be an industrial expansion. That's what you saw coming out of the doldrums in the 1970s. big industrial expansion, silver and the white metals went crazy. If we don't see that again, then you're better off positioning more in gold. But again, Miles, back to silver, didn't mean to stomp on you there, buddy.
No, you're fine. I mean, if I'm going to remain the chart purist like I try to be, devoid of my own personal opinions, silver's bearish. It's been bearish for a while, at least short term. I always
Short
got
term.
to,
Yep.
I always got a short term, mid term, long term. Long term, silver's obviously in a pretty significant bull market going back a few years now. But if we're just talking over the last few months, we had a break below a support level in silver last Wednesday while we were recording. Now we've had a bounce back up above that level, but honestly, I could see silver continue down here, which I think is completely reasonable. That support level was right at the 382 fib. We went down to the 50% line. We could easily go down to the $26, which is at the 618 fib. And that would be a very beautiful correction down on silver. The problem with silver is it just feels like so much because it does so much in a short period of time. Silver took a $10 rise since February. It was enormous. It was a 50% move almost in 2-3 months. Of course it needs to take a correction back down. But where that opens us up is that opens us up in the gold silver ratio getting back above 85-90. Now what we need is some ratio down in like the mid to high 50s so you can play both sides of that as it's doing it. So that's really what I'm looking for. Now I had a conversation, and Rob, you talking about the idea of the industrial usage here. I had a conversation with a client just yesterday who's kind of bailing on his platinum position. He gets it. He understands why we're still looking at it. But his argument is completely reasonable. In an economic crisis, why in the world would I own anything other than gold?
Oh, I love it. I think all three of us, we're precious metals advisors, but we're all three gold bugs.
Yep.
Right?
Yeah.
We like the white metals because ultimately they'll buy us more gold. That's it.
That's it.
Right? Anybody that's
and that's the
approaching
answer.
silver, anybody that's approaching silver as a long-term investment and buy and hold type deal, Miles, you have said over and over again, not its role. It doesn't do it well. Gold does it perfectly. And that's it. When the white metals are undervalued and you have this economic uncertainty and political uncertainty and you have high ratios, then you do it, in hopes of ending up with more gold in your portfolio as a result of that white metal outperformance in the short term. But it won't matter if you don't sell it. If you don't exit that silver position,
That's really
and you
hard.
keep holding,
Oh,
you'll
that's
miss it.
really hard for people. They see it do these crazy things and like, well, I can't let it go now. It's going to go to X or it's going to go to Y. I'm like, well, the ratio says that you might want to really move at least a third to a half. And that's the one
right.
thing that we have learned here at McIlvaney Precious Metals. It's not student body left and student body right. We have to do it in stages.
So as I figure out if I want to be with student body left or student body right, I think that might do it this week for Golden Rule Radio. Better yet, why not give your advisor with McIlvaney Precious Metals a call and let you know where you should be sitting with your precious metals portfolio, which side of that seesaw, and which way to build out your metals portfolio in the most advantageous way going forward would be. Love to talk with you about your personal precious metals portfolio. Bring a little bit of strategy to the long-term ownership of gold and silver. So we thank you again for joining us. If you liked what you heard, you can hit the subscribe button, ring the bell, head on over to our website at McIlvaney.com. You can find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. And again, if you'd like to chat about your personal portfolio, give us a buzz at 800-525-9556. Thanks for listening and have a great week.